And the sun is shining and spring is coming. And if you're wondering if you have enough money in your pocket to enjoy the upcoming season and the rest of your life, we have someone who answers those questions for us, Darren Farwell of the Farwell Group. Good morning, Darren.
Good morning, Marilyn. Now, before I start today, those from a women's perspective, listeners who know me will likely note the lack of mention of the Toronto Maple Leafs, and I shall remain silent. Last week, I spoke about one of the ever-challenging issues facing Canadian business owners, rising taxes. Not that business owners stand alone in that. Many middle-class Canadians have faced withering income tax increases over recent years. I recounted a happy story about helping a business owner reduce her forecast tax burden based on changes in the tax rules around passive investment income earned inside a private corporation. By planning ahead, we were able to identify 10.7% tax savings for tax year 2019. Of course, this needs to be reviewed by your accountant. In fact, business owners in Canada are facing the perfect storm these days. Number one, as discussed, taxes are increasing. Number two, the demographics are really challenging too. 50% of businesses in Canada will be sold over the next 10 years. So this strong supply is going to make it harder to get the right price, or maybe even get the right price at all when it comes time to exit your business. Number three, to top it all off, we are late in the investment cycle, and not managed properly, the next bear market, economic recession, could bring a decline in the stock market and business prices that could truly have a long-term negative impact on your savings and your retirement income.
You said it was going to be a happy story today.
I know that you're always looking for a happy story, Marilyn, so I'm just about to say how there is a happy story for this.
Oh, thank you.
And the happy story today is that business owners and other investors like you and me still have time to do some forward thinking. My happy story is that there are things you can do to protect your capital and therefore keep secure your long-term retirement income. Let me emphasize, however, the things you can do must be done proactively before we begin the 3 phases of decline. So here's the good news. The 5 things you can do to soften the blow of bear markets. And by the way, the stock market is considered to be in a bear market if it is down more than 20%. In 2008, during the depth of the financial crisis in Canada, the market was down 42% at one point in the year. Truly, that's the bear market growling at its loudest. Okay, back to the good news. Our happy story is there is still time to consider and make decisions to soften the blow. The 5 things you can do to soften the blow of the bear market on your savings and therefore your long-term retirement income are: number 1, reduce your overall portfolio risk. If you've been invested primarily in stocks in your portfolio, that will be called a growth portfolio, and generally that means anywhere between 80 and 100% of your portfolio invested in stocks. You could consider moving to a more balanced approach now while things are good. A balanced approach would look more like 50% stocks and 50% low-risk investments like GICs and bonds, and some balanced portfolios are 60% stocks and 40% low risk. So reduce overall portfolio risk. Number 2, just raise some cash. Leave your long-term investments in long-term investments. After all, missing just 10 of the best days in a year can significantly reduce your long-term returns. But while you stay invested with your long-term investment money, take some profits now, and perhaps in stages take a little bit more. For example, I have one client who's going to sell 10% now, leave that money in cash, and then we'll reevaluate things through the summer and into November to see if they'd like to sell another 10% and leave it as cash. Because, of course, that cash will hold value in down markets. So will gold, by the way, so you can also sell some investments at a profit and store some of that cash in gold-related investments. Number 3, buy insurance. There are products in the investment world called options. Buying a put option has similarities to insurance. A put option can go up in price in a down market. So while the price of your overall portfolio, the price of your overall investments is declining, the put option would be going up in value, thus offsetting some or all of your portfolio decline. Now, this is a sophisticated, specialized strategy, but for the right individual, it can be very powerful. So buying options or insurance for your portfolio is number 3. Number 4, just be aware. This is one that Warren Buffett talks about a lot. As much as anything, just understand what's likely to come and prepare yourself mentally and just ride it out. By just holding on to your long-term investment portfolio and accepting the fact that it will go down during some period, but will come out the other end, that will avoid having to pay taxes to sell things now. That's one of the disadvantages of selling. You won't have to interrupt your dividends being reinvested at much lower prices, which is what happens if you stay invested. You don't need to risk being out of the market if it continues to rise. And by the way, there's a very strong feeling that the market could still rise for some time. I'll talk about that in a second. And by being a long-term investor, you can just not worry about it and think about when the market will turn the other way. Finally, you could consider alternative investments. Again, these are highly specialized investments. They're one of my favorite ideas for where we are right now. Their objective is to earn 70% of the market if it continues to go up. That's called up capture. So if the market is up 12%, you would expect to be up around 8.5%. Still a nice return. So you do participate in a rising stock market. And don't be surprised if we do get another 2 to 3 years of very solid, high single-digit, low double-digit returns in the market, which is not what people are expecting. But when a bear market does come, you would be forecast to share in only 10 to 20% of the downside. So if the market is actually down 20%, your alternative investment would be down only 2 to 4%. Now, there aren't many managers that can do this, especially managers with a track record to prove it, but we have identified a few. So the happy story is that there are things you can do, things you can consider to protect your savings late in the investment cycle. I've highlighted 5. Review some of these ideas with your advisor to see how they might soften the financial impact and the emotional beating for you and your portfolio when the bear does begin to growl.
So it sounds like we have a destination. We all want to have investments making money, but that there might be some bumps in the road. So plan on the detours and maybe meander a little so you don't have to just sit in traffic.
Yeah, it's a good idea to think ahead, see what's coming. Like there's that software for your traffic. If you know there's traffic ahead, find a different way around it.
And then you're smiling as opposed to just sitting there in a car, grunting and groaning at the car in front of you.
Growling like the bear.
Exactly. So if someone wants to talk about the ways to soften the blow of the bear market, or maybe just have eyes for a second opinion on their investments, are you going to work today?
I am, yes.
And if someone wants to speak to you, will you answer the phone?
I will.
So 416-863-7501. You can call Darren today or anytime and book an appointment and have someone put a fresh set of eyes on your investments to make sure that you're getting what you need out of them and that your future holds detours that are pleasant if there are any bumps in the road. So the Farwell Group, Darren Farwell, been doing this since 1986, 416-863-7501. And I say that 1986 because there's a track record there in history so that you can be confident that there's someone there to help you protect your future. Be proactive, get the second opinion, have fresh eyes on your portfolio, and then don't sit back and cry. Sit back and smile because you've done what you can to protect your assets. Thank you, Darren, and I look forward to learning more next week.
You're welcome, Marilyn. Enjoy the nice weather this weekend.